Hey everyone, in this video, I'm going to bring to your attention one growth stock that's down 95.4% off its highs that I think you might regret not buying on this dip. So before I reveal what this growth stock is, I'm going to show you some of its financial metrics and explain why I think this is a buying opportunity right now. So let's get right into it, starting with its revenue. Now, what I have here is a chart of its trailing 12-month revenue, and you can see explosive growth here from 2019 all the way through 2022, and then a decreasing trend line here. And of course, when I see something like this, what immediately jumps to my attention is, okay, this company benefited from the pandemic, and now that economies are reopening, it's hurting this company's revenue. And that would be a true assessment to make here with this company. But to make matters worse, this company overinvested during the pandemic, thinking that this kind of growth would continue even as economies reopened. So this revenue decline here really put the company in a troublesome situation. This revenue decline put the company in a troublesome situation because it invested, it built out operations, it built out an expense base with the intention, with the thinking, with the expectation that, okay, revenue is going to stay up, it's going to grow from here. We need to be ready for this growth, so let's expand our operations. And now that it went the opposite direction, you have to correct for all that expansion that you did. And so that's what's hurt this company. That's why it's down 95%. But I will say that they've made excellent progress in recovering from those mistakes that they made during the pandemic. So let me show you another thing here. What I have here is the company's cash flow from operations to sales over the trailing 12 months. And again, you could see here explosive growth here, improvement to the excellent 30%, really phenomenal rates here. And then the big crash, right? From positive 30% all the way down to negative 60% at the peak bottom here at the trough. But like I mentioned, they've made some good steps forward. They've made corrections. They've adjusted downward, divested some areas, laid off some individuals, unfortunately, cut costs wherever they could, and now they're moving back up. So from negative 60, they're now up to negative 24% in terms of cash flow from operations to sales. And if they continue on this trend, I wouldn't be surprised if in the next couple of quarters this metric turns positive. If this metric turns positive, I would not be surprised. Additionally, the biggest mistakes that were made for this company were on its hardware side of the business. So this company has both hardware and software, and it generates revenue from the software side of the business, a subscription fee that generates between $40 and $50 per month, where it has millions of customers. And this side of the business, very profitable, over 70% profit margins in this side of the business. And it's not, so that means it's not expensive to serve these customers. What the mistakes they made was on the hardware side. They overinvested in warehousing, in manufacturing, in logistics and delivery, in research and development, in all of that, in inventory. And that's the area that has the biggest problems, but they've made corrections here. So they've dwindled down the inventory, brought down the operations, brought down logistics, and it's only a matter of time. If they can just shrink this side of the business, this other side, the software side, is an incredibly lucrative business. So they're making good progress here, and I think for the longest time I've been saying for this company to wait before buying it, wait before buying it, and finally now I'm starting to say it's become time to start to get in here. So one final thing I will note, look at the valuation. So here I have the forward price to sales ratio for this company is trading at a forward price to sales of 0.93. It's near the cheapest this stock has been, arguably ever. And it's been here for a while now, right? It's been here for a while as it's hit the bottom. Used to trade at a forward price to sales at much, much higher, close to 12 around July of 2021. So incredibly discounted valuation here, and you're getting it I believe right at the on the cusp of its big turnaround, the incremental boost into profitability, into positive cash flow from operations. A couple of steps away, but I'm thinking you got to get in before those next steps happen, because when they do, the stock price will jump and you won't be able to get it at this price. That's why I'm saying this growth stock, you might regret not buying it on this dip. So what's the name of this stock? You haven't guessed already. It is Peloton. Peloton, one of the absolute pandemic darling stocks that has put itself in a tough situation but is recovering strongly. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.